Dividends are a key part of many investors' portfolios and investment decisions. To know whether dividends are right for you, it's best to evaluate what they are, how they work, and how to decide which ones are the right ones for you. So first of all, what is a dividend? Dividends are a portion of a company's earnings paid out onto its shareholders. However, not all companies pay them out. Generally, more established companies are more likely to pay out dividend payments for the sole reason that they are able to afford to do so. A startup or small business would need to use a large chunk of its earnings to build products, hire new staff, and expand its operations. Therefore, would hold back on paying dividend payments to shareholders in an effort to aid growth. Let's look at how stock dividends work. The management of a company decides the size and frequency of dividend payment. The size of a dividend payment is often seen as an indicator of a firm's performance and future prospects. There are two main types of dividend payments. Let's break them down. Number one is cash dividends. Cash dividends are by far the most popular form of dividend payments. They are real money payouts that companies make to their shareholders. Thus, a company earns money and will pay a certain portion of it to its shareholders. And number two is stock dividends. Unlike cash dividends, instead of money, they get more shares in the company as a form of dividend payment. For instance, a 5% stock dividend would mean you get 5 more shares in the company for every 100 shares you own. However, when it comes to dividend payments, it's not that simple. Tax is involved. In the UK, dividends are liable to taxation. The dividend tax rate for basic rate taxpayers is 8.75%. But all UK residents have a dividend tax allowance of £1,000 for the tax year 2023 to 24. Meaning that the first £1,000 of dividend income is tax-free. Before you go rushing into investing in dividend stocks, there are some things that you need to know that will help you best evaluate what to invest in. Number one is a dividend yield. A dividend yield is probably the most common metric used to evaluate a firm's income credentials. The yield tells you how much a company pays out in dividends relative to its current share price. Two is a dividend payout ratio. A less looked at metric, at least compared to dividend yields, is the dividend payout ratio. This tells you how much a company has paid out in dividends relative to its profit. To calculate it, you divide the total amount of dividends a company has paid out by its net income. So if you imagine a firm has made £1,000 in profit and paid out £500 in dividend, then you would have a dividend payout ratio of 0.5. And three is a dividend cover. The dividend cover is similar to the payout ratio and is commonly used to figure out how sustainable a company's dividend payments are. To calculate it, you do the inverse of the payout ratio. You divide a company's profit by the value of its dividend payment. Overall, dividend stocks can be seen as a good investment for long-term investors, as they may offer a return if held for a number of years. If you'd like to learn more, XTB's Learn to Trade Academy offers over 30 plus hours of free educational content, in addition to a daily market analysis, articles on all about trading, and in-depth ebooks on fundamental and technical analysis. Subscribe to XTB to learn more about trading and investing.